Imagine a giant swimming pool filled with companies. This is the stock market. It's where businesses go to raise money. They do this by selling small pieces of themselves called stocks. These stocks are like tickets to join the pool party. When you buy a stock, you're buying a tiny part of that company. You become a part owner, a shareholder. Just like owning a piece of a pizza, you own a slice of that company's success. The stock market is where these slices are bought and sold every day. It's like a giant auction where prices go up and down based on how well people think a company will do. If people believe a company will grow and make more money, they want its stock. This demand drives the stock price up, but if people think a company might struggle, they might sell their stock. This can push the price down. It's all about supply and demand. The stock market can be exciting and a little unpredictable, just like a fun day at the pool. Let's imagine a delicious apple pie. You can't buy the whole pie, but you can buy a slice. Stocks are like slices of a company. When you buy a stock, you own a small piece of that business. Each slice represents a share of ownership. If the company does well, the value of your slice, your stock, could go up. This means you could sell your slice for more than you paid for it. That's how people make money in the stock market. Of course, if the company doesn't do well, the value of your slice could go down. That's why it's important to choose your slices, your stocks, carefully. You want to pick companies you believe in, companies you think will be successful in the long run. Remember, owning a stock means you're part of the company's journey. You're along for the ride as they grow and face challenges. It's like cheering for your favorite sports team, but instead of just a jersey, you own a piece of the action. Not all slices of pie are created equal, and the same goes for stocks. There are two main types, common stock and preferred stock. Let's break it down. Common stock is like the classic slice of pie. When you own common stock, you have voting rights in the company. You can voice your opinion on important decisions. Plus, if the company does really well and wants to share its profits, you might get paid a dividend. It's like getting a bonus slice of pie. Preferred stock is a bit different. It's like getting a special slice of pie with extra whipped cream. Preferred stockholders usually don't get voting rights, but they do get priority when it comes to dividends. They're first in line for a taste of those profits. Choosing between common and preferred stock depends on what you're looking for. Do you want a say in the company's future with potential for dividends? Or do you prefer a higher chance of regular dividend payments? It's all about finding the right slice for your investment plate. Ready to dive into the stock market pool? You'll need a special key, a brokerage account. Think of it like a passport to the world of investing. Brokerage accounts let you buy and sell stocks online with ease. Opening a brokerage account is easier than you might think. Many banks offer them, or you can choose from online platforms. It's like setting up an online shopping account, but instead of clothes or gadgets, you're buying pieces of companies. When choosing a brokerage account, look for one that's user-friendly, especially if you're new to investing. Pay attention to fees too. Some brokerage accounts charge a commission for every trade, while others offer commission-free trading. Once you've opened your brokerage account and deposited money, you're ready to start investing. It's like having a shopping cart ready to be filled with stocks. But remember, just like with any shopping spree, it's important to have a plan and not overspend. Section 5. Don't put all your eggs in one basket. Diversification. Imagine putting all your eggs in one basket. What happens if you drop it? Disaster. The same goes for investing. You don't want to put all your money in just one stock. This is where diversification comes in. It means spreading your money across different types of investments, like different stocks, bonds, or even real estate. It's like having a variety of snacks in your lunchbox instead of just one thing. Why is diversification so important? Because it helps reduce risk. If one investment doesn't do well, you have others to cushion the blow. It's like having a safety net for your money. Think of it like building a strong house. You wouldn't use just one type of brick, would you? You'd use a variety of materials to make it sturdy and resilient. Diversification is like building a strong portfolio of investments that can weather market ups and downs. Section 6. Starting small baby steps in investing. You don't need to be a millionaire to start investing in the stock market. In fact, you can begin with small amounts of money. It's like dipping your toes in the pool before jumping in head first. Many brokerage accounts allow you to buy fractional shares, which are tiny pieces of expensive stocks. This means you can invest in companies you believe in, even if you can't afford to buy a whole share. Starting small is a great way to get comfortable with investing. You can learn the ropes, track your investments, and gain confidence without risking a lot of money. It's like practicing riding a bike with training wheels before hitting the open road. Remember, investing is a marathon, not a sprint. It's about slow and steady growth over time. By starting small and gradually increasing your investments, you'll be amazed at how your money can grow over the long term. Section 7. Riding the roller coaster, risks and rewards. The stock market can be like a roller coaster ride. There will be ups and downs, twists and turns. It's important to be prepared for both the good times and the challenging ones. Investing in stocks comes with risks. The value of your investments can go down and you could lose money. That's why it's crucial to do your research, choose companies wisely, and diversify your portfolio. But with risk comes potential reward. When the stock market is doing well, your investments can grow significantly, helping you build wealth over time. It's like riding the roller coaster to the top and enjoying the view. Remember, investing is a long-term game. Don't panic if the market takes a dip. Stay focused on your goals, be patient, and ride out the waves. Just like on a roller coaster, the thrill comes from the entire experience, not just the upswings. Section 8. The tortoise and the stock market. Patience is key. Remember the story of the tortoise and the hare? Slow and steady wins the race. The same applies to investing. Patience is key to success in the stock market. Don't expect to get rich quick. Investing is about gradual growth over time. It's like planting a tree. You need to nurture it, give it time to grow strong roots, and be patient for it to bear fruit. Avoid making impulsive decisions based on short-term market fluctuations. Just because a stock is going up or down today doesn't mean it will continue that trend tomorrow. Stick to your investment plan and focus on the long term. Remember, Rome wasn't built in a day, and neither is a successful investment portfolio. Be patient, stay the course, and let time work its magic on your investments. Section 9. Keep learning, keep growing your investment journey. Congratulations on taking the first steps on your investment journey. Remember, learning about the stock market is an ongoing process. It's like exploring a vast and exciting new world. There are countless resources available to help you on your way. Read books, articles, and financial websites. Follow reputable financial experts and learn from their insights. The more you know, the more confident you'll become as an investor. Don't be afraid to ask questions. Talk to financial advisors, join investment clubs, or connect with other investors online. Sharing knowledge and experiences can be incredibly valuable. Remember, investing is a journey, not a destination. Enjoy the process, keep learning, and never stop growing your financial knowledge. The more you put into it, the more rewarding it will be.